Welcome to the world of real estate investment. In this video, we'll explore how investing in property can be a powerful way to build wealth and secure your financial future. Real estate has long been considered a stable and rewarding asset class, offering both income and appreciation potential. Whether you're a beginner or looking to expand your portfolio, understanding the basics is essential. Let's start by uncovering what makes real estate investment unique and why so many people are drawn to it. By the end of this journey, you'll have a solid foundation to begin your own investment adventure. Real estate refers to land and any permanent structures attached to it, such as houses, apartments, or commercial buildings. When you invest in real estate, you're purchasing a tangible asset that can generate income or increase in value over time. Unlike stocks or bonds, real estate is a physical property you can see and manage. This makes it appealing for those who prefer hands-on investments. Understanding the different types of real estate is the first step toward making informed decisions and maximizing your returns. There are several main types of real estate investments: residential, commercial, industrial, and land. Residential properties include single-family homes, condos, and apartments. Commercial real estate covers office buildings, shopping centers, and hotels. Industrial properties involve warehouses and factories, while land refers to undeveloped property. Each type has its own risks and rewards, so it's important to choose the one that aligns with your goals and resources. Let's look at each category in more detail to help you find your ideal investment niche. Investing in real estate offers several advantages. First, it provides the potential for steady cash flow through rental income. Second, properties often appreciate in value over time, increasing your wealth. Third, real estate can offer tax benefits such as deductions for mortgage interest and depreciation. Finally, owning property can diversify your investment portfolio, reducing overall risk. These benefits make real estate an attractive option for both new and experienced investors seeking long-term growth and stability. Cash flow is the net income you receive from your property after all expenses are paid. This includes rent collected minus mortgage payments, taxes, insurance, and maintenance costs. Positive cash flow means your property is generating more income than it costs to own, which is the goal for most investors. Monitoring your cash flow helps you ensure your investment remains profitable and sustainable over time. Let's explore how to calculate and maximize your cash flow. Appreciation refers to the increase in a property's value over time. This can happen due to market demand, improvements to the property, or economic growth in the area. Appreciation is a key reason why many investors choose real estate, as it can significantly boost your returns when you sell. However, it's important to remember that appreciation is not guaranteed and can vary by location and market conditions. Smart investors research trends and choose properties with strong growth potential. One of the most attractive aspects of real estate investment is the potential for tax benefits. Investors can often deduct mortgage interest, property taxes, and certain expenses related to managing the property. Additionally, depreciation allows you to reduce your taxable income, even if your property is increasing in value. These tax advantages can improve your overall returns and make real estate a more efficient investment compared to other asset classes. Diversification is a key principle in investing, and real estate offers a great way to achieve it. By adding property to your portfolio, you reduce your reliance on stocks and bonds, which can be more volatile. Real estate often moves independently of the stock market, providing stability during economic downturns. This balance helps protect your wealth and ensures you're not putting all your eggs in one basket. Let's see how real estate fits into a diversified investment strategy. When it comes to real estate, you can choose between active and passive investing. Active investors buy and manage properties themselves, handling everything from tenant selection to maintenance. Passive investors, on the other hand, might invest in real estate funds or trusts, letting professionals manage the details. Each approach has its pros and cons depending on your time, resources, and risk tolerance. Understanding these options helps you select the best path for your goal. Direct ownership means buying a property yourself and becoming the landlord. This approach gives you full control over the investment, from choosing tenants to setting rent prices. While it can be rewarding, it also requires time, effort, and knowledge of property management. Direct ownership is best suited for those who want hands-on involvement and are willing to handle the responsibilities that come with being a landlord. REITs are companies that own or finance income-producing real estate. By investing in a REIT, you can gain exposure to real estate markets without owning property directly. REITs are traded on major stock exchanges, making them easy to buy and sell. They offer liquidity, diversification, and professional management, making them a popular choice for passive investors. Let's explore how REITs work and their role in a balanced portfolio. Crowdfunding platforms allow multiple investors to pool their money and invest in larger real estate projects. This approach lowers the barrier to entry, making it possible to invest with smaller amounts of capital. Crowdfunding offers access to a variety of property types and locations, but it's important to research each platform and project carefully. While it can be a great way to diversify, always consider the risks and fees involved. Investing in rental properties is one of the most common real estate strategies. By purchasing a home or apartment and renting it out, you can generate steady income while building equity. Successful rental property owners focus on location, tenant quality, and property maintenance. It's important to understand local rental markets and laws to maximize your returns and minimize risks. Let's look at what makes a rental property a good investment. Flipping involves buying properties, renovating them, and selling for a profit. This strategy requires a keen eye for value, renovation skills, and market knowledge. While flipping can offer quick returns, it also carries higher risks and requires more active involvement. Successful flippers budget carefully, manage timelines, and understand local market trends. If you enjoy hands-on projects and fast-paced investments, flipping might be the right strategy for you. Vacation rentals, like those listed on Airbnb or VRBO, offer another way to invest in real estate. These properties are rented out short-term to travelers, often generating higher income than traditional rentals. However, they require more active management and are subject to local regulations. Location is especially important for vacation rentals, as demand depends on tourism and seasonal trends. Let's explore the pros and cons of this investment approach. Commercial properties include office buildings, retail centers, and warehouses. These investments often involve longer leases and higher returns, but also require more capital and expertise. Commercial real estate can provide stable income and potential for appreciation, but it's important to understand market cycles and tenant needs. This sector is best suited for experienced investors or those working with professional advisors. Industrial properties, such as warehouses and factories, play a vital role in the economy. These investments are often leased to businesses for manufacturing, storage, or distribution. Industrial real estate can offer stable long-term income, especially as e-commerce and logistics grow. However, these properties may require specialized knowledge and have unique risks, such as changes in industry demand or environmental regulation. Investing in land means purchasing undeveloped property with the hope that it will increase in value. Land can be used for agriculture, development, or held for future appreciation. While land investments can offer significant returns, they also come with risks like zoning changes, lack of income, and market fluctuations. It's important to research the area and have a clear plan for your investment. Old saying in real estate is location, location, location. Where a property is located can have a huge impact on its value and income potential. Factors like proximity to schools, transportation, and amenities can attract tenants and buyers. Researching neighborhoods and understanding local trends is essential for making smart investment decisions. A great location can turn an average property into a profitable one. For investing, it's crucial to conduct thorough market research. This means analyzing property values, rental rates, vacancy trends, and economic indicators in your target area. Understanding the local market helps you identify opportunities and avoid costly mistakes. Use online tools, talk to local agents, and visit neighborhoods to gather information. The more you know, the better your investment decisions will be. Most real estate investors use financing to purchase properties. This means taking out a mortgage or loan to cover part of the cost. Understanding your financing options, such as fixed rate or adjustable rate mortgages, is essential. Lenders will look at your credit score, income, and the property's value before approving a loan. Shop around for the best rates and terms to maximize your returns. Down payment is the upfront cash you pay when buying a property. In real estate, down payments typically range from 10% to 25% of the purchase price, depending on the type of property and lender requirements. The more you put down, the lower your monthly payments and interest costs will be. Saving for a down payment is a key step in preparing for your investment journey. Leverage means using borrowed money to increase your investment potential. In real estate, leverage allows you to control a valuable asset with a relatively small amount of your own money. While leverage can amplify your returns, it also increases risk if property values decline. Smart investors use leverage carefully and ensure they can cover loan payments even during tough times. Every investment carries risk, and real estate is no exception. Risks include market downturns, tenant issues, property damage, and unexpected expenses. To manage risk, diversify your investments, maintain adequate insurance, and keep cash reserves for emergencies. Regular property inspections and proactive maintenance can also help protect your investment. Being prepared is the best way to safeguard your wealth. Managing a property involves finding tenants, collecting rent, handling repairs, and ensuring legal compliance. Some investors choose to manage properties themselves while others hire professional property managers. Good management is essential for maximizing income and minimizing headaches. If you're new to real estate, consider starting small or partnering with experienced managers to learn the ropes. Real estate investments are subject to various laws and regulations, including landlord-tenant laws, zoning rules, and fair housing requirements. It's important to understand your legal obligations and stay compliant to avoid fines or lawsuits. Consulting with a real estate attorney or experienced agent can help you navigate the legal landscape and protect your interests. Exit strategy is your plan for selling or transferring your investment. Common exit strategies include selling the property, refinancing, or passing it on to heirs. Planning your exit in advance helps you maximize profits and minimize taxes. Market conditions, property value, and your financial goals will influence the best time and method to exit your investment. Equity is the difference between your property's value and the amount you owe on it. As you pay down your mortgage and your property appreciates, your equity grows. Building equity is a key benefit of real estate investment, as it increases your net worth and provides options for future borrowing or selling. Let's see how you can accelerate equity growth. Innovating or improving a property can increase its value and rental income. Value-add strategies include updating kitchens, adding amenities, or enhancing curb appeal. These improvements can attract better tenants and justify higher rents. However, it's important to budget carefully and avoid over-improving for the neighborhood. Smart renovations can boost your returns and make your property stand out. Before purchasing a property, analyze the deal carefully. Look at the purchase price, expected rental income, expenses, and potential appreciation. Use metrics like cap rate, cash-on-cash return, and gross rent multiplier to compare opportunities. Thorough analysis helps you avoid bad investments and focus on properties with strong potential. Let's break down the key numbers you should know. Capitalization rate or cap rate measures a property expected return based on its income. It's calculated by dividing the net operating income by the property's purchase price. A higher cap rate means a better return but may also indicate higher risk. Cap rates vary by location and property type, so compare similar properties in your area. Understanding cap rates helps you make smarter investment choices. Cash-on-cash return measures the annual income you receive from a property compared to the cash you invested. It's a useful metric for evaluating the efficiency of your investment. To calculate, divide your annual pre-tax cash flow by your total cash invested. Higher cash-on-cash returns indicate better performance, but always consider other factors like appreciation and risk. Gross rent multiplier (GRM) is a simple way to compare rental properties. It's calculated by dividing the property's price by its annual rental income. A lower GRM suggests a better deal, but it doesn't account for expenses or vacancies. Use GRM as a quick screening tool, then dig deeper into the numbers before making a decision. Networking with other investors, agents, and professionals can open doors to new opportunities and valuable advice. Attend local real estate events, join online forums, and build relationships with lenders and contractors. A strong network helps you find deals, solve problems, and stay informed about market trends. Remember, real estate is as much about people as it is about properties. Real estate agents can be valuable partners in your investment journey. They have access to market data, negotiation skills, and local knowledge. Choose an agent who understands investment properties and your goals. A good agent can help you find the right deals, navigate paperwork, and avoid common pitfalls. Building a strong relationship with your agent is a smart move for any investor. Real estate investing is a long-term game. Building wealth through property takes time, patience, and persistence. Markets can fluctuate, and not every deal will be a home run. Stay focused on your goals, keep learning, and don't rush into decisions. Over time, your efforts will pay off and your portfolio will grow stronger. Every investor makes mistakes, especially in the beginning. The key is to learn from them and adjust your strategy. Keep track of what works and what doesn't, and don't be afraid to seek advice from more experienced investors. Mistakes are valuable lessons that can help you become a smarter, more successful investor in the long run. The real estate market is always changing. Stay informed by reading industry news, following market trends, and attending educational events. Knowledge is power, and the more you know, the better your investment decisions will be. Make learning a lifelong habit to stay ahead of the curve and adapt to new opportunities. Technology is transforming the real estate industry. Online platforms make it easier to find properties, analyze deals, and manage investments. Tools like virtual tour, data analytics, and property management software save time and improve decision-making. Embracing technology can give you a competitive edge and streamline your investment process. Sustainability is becoming increasingly important in real estate. Eco-friendly properties and energy-efficient upgrades can attract tenants and reduce costs. Green building certifications and sustainable practices are not only good for the environment but can also enhance property value. Consider sustainability when making investment decisions for long-term success. Real estate investment isn't limited to your local area. Global markets offer opportunities for diversification and higher returns. However, investing internationally comes with additional risks, such as currency fluctuations and legal differences. Research each market carefully and consider working with local experts to navigate unfamiliar territory. Real estate market moves in cycles with periods of growth, stability, and decline. Understanding these cycles helps you time your investments and avoid buying at the peak. Pay attention to economic indicators, supply and demand, and local trends. Being aware of market cycles can help you make smarter, more profitable decisions. Successful real estate investors often work with a team of professionals, including agents, lenders, contractors, and accountants. Each member brings valuable expertise and helps you navigate the complexities of investing. Building a reliable team can save you time, reduce stress, and improve your results. Choose your partners carefully and communicate openly for the best outcomes. Clear goals are essential for real estate success. Decide what you want to achieve, whether it's monthly income, long-term growth, or a mix of both. Set realistic timelines and track your progress regularly. Your goals will guide your decisions and keep you motivated even when challenges arise. Let's set the foundation for your investment journey. Congratulations on reaching the end of our real estate investment journey. You've learned the basics, explored different strategies, and discovered how to analyze deals and manage risks. The next step is to apply what you've learned, start small, and continue building your knowledge. Real estate investing is a rewarding path that can lead to financial freedom and long-term security. Good luck as you begin your investment adventure.